Great to have you here this afternoon. What are we learning from Powell firstly? Because taking a step back from the decision, it seems that he's not really responding. He's not really worried, at least not expressing it, about some of the sell-off we've had in risk assets.
Well, and that's the great thing about the Fed and why the Fed is independent and why their deliberations are in secret, is because the Fed is not supposed to be beholden on the markets. I mean, the market voted today and they didn't like it. Well, when you raise interest rates, of course the stock market's not going to like it. But we have a Fed, and it was reassuring that we have a Fed that says, I'm going to think about the long-term health of the economy, not today's market price, not what President Trump wants me to do, not the midterm elections, but what's right for the health of the economy. And that was something that I thought was reassuring. I mean, the Fed was right to raise interest rates today. We have got to get interest rates and the economy back in a long-term stabilized place. And when money is free and debt is soaring like it is, that's not good for the long-term health of our economy.
I think that's a really salient point that people forget sometimes, because when I look at the FANG suite of companies, the high growth stuff, the big winners of the bull market, down 35–40% because of what's happened on the Fed's path now maybe this year, where people are finally going, you know what, actually, I don't need to hold all these growth companies. If this is what's happening, then maybe it's good that we get this thing out of the way, because then what kind of sell-off are we going to have to deal with if they don't move? And suddenly we're selling off a market that's at a 30 trailing PE instead of a 21. And then what's the effect of that? So is this kind of along the same lines of what you're saying, David?
Yeah, exactly. The stock market is supposed to reflect the intrinsic value of the companies that are made up of the stock market. And we have to look at the intrinsic value of companies. Now, in 2009 from today, the intrinsic value of those companies, if you look at the price in the stock market, has gone up almost fourfold. Just look around. Do you really think that General Motors and Apple Computer and Verizon and Disney are 4 times more valuable today than they were about a decade ago? Of course not. One of the problems with what has happened with our interest rates and depressing interest rates is it has a sort of perverse impact on markets and decisions. That's why we have a situation now where corporate debt is at nosebleed levels and people aren't talking about it. I'm way more concerned about where corporate debt is and where our national debt is and consumer debt than where the stock market happened to close today. I mean, our corporate debt is 45% of GDP. It's never been that way before in recent history. And the last 2 times it came close to that was right at the dot-com bubble and right at the housing bubble.
So, David, then where do we look then to see this being expressed, or to your point, has it not been expressed? We've been talking about credit spreads widening out a little bit within the latest volatility. We have been talking about the inflation expectations dropping in a big way, suggesting that, you know, we've got crude oil situation, but also maybe just growth slowing down. How close are we then to that credit type of crunch where maybe we've seen it? Remember 2015, same thing. We saw credit spreads blow out in a big way, but then we just kept on cruising and everything was all right.
Well, the thing I worry about is because interest rates have been kept so low and artificially low, that debt service is quite low. So corporations have been able to increase the amount of debt they had, as have consumers, as has the federal government. So as interest rates starts to creep up, what worries me the most is what that's going to do to debt service, because you need to have the underlying cash flow, whether you're a consumer or a company, to service that debt. Now, right now, today, consumer debt is so high that 26% of a person's paycheck goes to debt. That's unprecedented. And we're pushing almost $4 trillion of consumer debt. Now, that's a big number, and that may not mean anything to most people, but think of it this way. A decade ago, it was $2.5 trillion.
Sure.
Now, remember,
we've got a lot more GDP growth since, right, David? We've got growth behind that, though. We've had a lot of, we haven't had big wage growth yet, but if you were to take that debt, put it next to GDP, kind of normalize, it doesn't look quite as bad, does it?
Oh, I think it looks horrible. 45% of GDP. I think, and that's the number I'm talking about. And I agree with you, Oliver. I think that is what you should be looking at, is where debt is compared to the GDP. And it's bad right now. Yeah. And I think that's one of the things that we need to be focused on, as well as we've got $23 trillion worth of federal debt, which doesn't, by the way, take into consideration how we're going to cover our entitlements like Social Security, Medicare, and Medicaid. Now, I don't think the world is falling apart, but I think it's time for us to sort of remove the drug that we got when we went into the emergency room in 2009 and got that great sort of hit of morphine to get us through that tough time. We need to pull that out and we say it's time now that we walk out of the emergency room and we start to operate in a normal economy. A normal economy is not 0% interest rate, which is basically what we have. In fact, the way to look at the interest rate is to look at the inflation-adjusted interest rate. And over the last decade, we've actually had negative interest rate.
Yep.
And that causes people to make perverse decisions.
Yeah. David, so then if I follow this kind of logic and the scenario that you're laying out, then, all right, we got our Fed hike today. And next year, we continue to look at the data. If they continue to hike the 2 times that right now the dot plot is suggesting, that would, and it should expose the problems that you're saying are there. Once those problems are exposed, then are we in a scenario where not only does Powell have to back off, but he has to think about loosening things? Are the problems you describe as systemic in scale to where it might actually then drive this sort of QE4 that was a joke like 18 months ago, but now people are really starting to think that it's a possibility?
No, I think what Powell is doing, and I think what the Fed is sensibly trying to do, is to ease us back into a normal interest rate environment. And if we do that over time, then there is no catastrophe. The corporate debt can be managed through cash flow, consumer debt can be managed. But if we keep this interest rate artificially low for so long, eventually the system is going to break. So what the Fed is doing is they're saying, we're going to bring interest rates up gradually. I mean, he's talking about only 2 increases next year, maybe 1, maybe 2. And he's also ending this quantitative easing, and they're selling into the market $50 billion worth of treasuries each month. That's a nice gradual way to return back to where we were at pre-2009 levels. If they do that and they're successful, then we're fine. And that's what the Fed's trying to do. Now, the reason why the Fed is not a political environment is because he doesn't have to worry about midterm elections, and he doesn't have to worry about 2022 or 2020. Sure. He can work on the long-term health of the economy.
Yeah. All right, David, we got to leave it there. Let's continue the conversation, though. Really great addition to our coverage today, Mr. Dodson. Thanks for joining.
Good. Happy to be here.
Thanks,
Oliver.
David Dodson joining us from Stanford University's Graduate School of Business.